second half of the 2024 Focus Day that we're doing online. As a reminder, this is a precursor to the Derivatives Forum that occurs in Frankfurt toward the end of February in 2025. Something that I think there are a lot of us that if there's a conference we really enjoy going to, and it's at the same time every year, we always have that circled on our calendar. I always know the last week of February is that I want to be in Germany and not in the U.S. And it's not for the weather; it's for the Derivatives Forum. We're going to talk about VSTOXX in this section. I'm going to start out with Hamish Siegapal from STOXX, and then turn to Ismail Afsa. Sorry about that, from J.P. Morgan. And then we're going to have a panel with Sophie Granchi from Eurex, Noel Smith from Convex Asset Management, and Charles Lacari from Melanin Capital. I know I'm butchering all kinds of pronunciations right now. And then we'll wrap things up with somebody who I read every week, with Matthew Korn from Eurex. He puts out some really good information on VSTOXX every week. I look forward to talking about that. We're going to talk about VSTOXX this past year, how it acted around the French election, and the elephant in every room, or the donkey in every room, depending on your political allegiance. The U.S. election, we're definitely going to be hitting on that. But I want to start out and bring Hamish in. If you could give us a self-introduction real quick when you jump on, and then we'll start digging into what you do with respect to efforts around VSTOXX.
Sounds good. Well, thanks, Russell, for having me. Thanks to our partners at Eurex for having me as well. Quick introduction of myself. I'm an index guy, always have been. I spent the bulk of my career at Credit Suisse on the commodities and QIS desks. And I've spent the last few years at STOXX focusing on developing new products.
We talked about short-dated VSTOXX 50 option trading for an hour. And VSTOXX did start to work its way into the conversation. Can you talk a bit more about how you think investors should be thinking about VSTOXX right now, and uses, or just as an indicator, et cetera?
Sure, and I'll zoom way out for a few minutes and talk a little bit about how investors should be thinking about it. So you hear it referred to in the market a lot as a fear gauge, and I think that's mostly correct. A few things it's not telling you. So it's not telling you anything about history, about what happened. It's very much a forward-looking indicator, a measure of the expectations of the market. And it's not telling you anything about where the VSTOXX 50 price will be in 30 days. I think if it was, it'd be a bit more of a successful index. But what it's telling you is a measure of uncertainty. Right? Think back to the basics of volatility. It's all based around this assumption that the returns of financial assets follow a normal distribution. That's the nice bell curve we're all familiar with. We know that's not exactly the case in reality, but it's a key assumption. And so when you think about the VSTOXX level, when the VSTOXX is high, it's telling you that that range of outcomes is pretty wide. That distribution is pretty wide. And conversely, when it's low, it's telling you the market has more confidence in that range of outcomes. The direction of the VSTOXX 50 is more knowable. And that can be up or down. And that comes back to where the fear gauge falls down a little bit, is that when you look at the direction of the VSTOXX 50, the VSTOXX is not telling you which direction it's going. Now, it is the case that volatility tends to be negatively correlated with underlying asset prices. So typically, when you see the VSTOXX at a high level, it coincides with a downturn in the VSTOXX 50, but that's not always the case. It's not a truism. We've actually seen that in the past few months, since August, where the VSTOXX has risen alongside the VSTOXX 50, but it is coming back to very much a measure of uncertainty. I think the other thing investors should think about, and again, this is more kind of the basics, when thinking about the VSTOXX, is how index volatility is determined. So there's two main drivers of that. Of course, you have the underlying asset prices, but also the relationship between them, the correlation between them. So all things being equal, if you had a portfolio and the volatility of your underlying assets stayed the same, but the correlation between them increased, the volatility of the overall index would increase. And that goes back to the only free lunch in finance, diversification. If the assets are lowly correlated, They tend to dampen the movements of each other and dampen the index volatility. But when you see correlations rise, typically that means the index volatility rises as well. That's just some of the basics in terms of how investors should be thinking about the VSTOXX, but really, when we think about it, it's a measure of uncertainty in the market.
Yeah, it'd be great if volatility indexes would give us the magnitude of the anticipated move and the direction. I guess we have to try and use skew for that. So we mentioned it at the very beginning here. The world does seem to be focused on the U.S. election. To a certain, I think I know a lot of people in the U.S. that have a little bit of election fatigue going on. We're just ready to get it over with. Hopefully it'll be over in November. So VSTOXX has had some pretty interesting price action. You just mentioned that it's been trending higher in line with the underlying market. And I think the election has something to do with that. It also behaved very differently when the snap French election got announced, where VSTOXX went up, VIX didn't really follow it higher. Do you think that's demonstrating why VSTOXX is so important for the European markets? Just that it can give you a European specific indication of risk?
Yeah, absolutely. And when I think about the difference between the VSTOXX and other volatility benchmarks, the biggest difference is probably the most obvious one, right, which is the underlying index, the VSTOXX 50 versus US benchmarks. And we can, of course, quantify those differences. So tracking error is a good stat to do that. Tracking error is, of course, just another volatility measure. It's measuring the difference in the volatility of the difference of returns of two portfolios or two indices. And when you look at that recently, the tracking error between the VSTOXX 50 and US benchmarks is running, it's called over 10%. And we think back to what that actually means with regards to distributions and volatility. It's saying over the course of a year, there's something like better than a 1 in 3 chance that the returns of these two indices differ by more than 10%. So it's huge scope for differentiation. And you can decompose that tracking error number using, for example, a factor risk model. And it's going to tell you some more kind of intuitive, obvious things. The biggest driver in risk between a US benchmark and a European benchmark is exposure to countries. So the VSTOXX 50 is 40% French companies. And that jives with exactly what you said with regards to French elections earlier this year in June, when we saw the VSTOXX pop up to about 20, whereas the VIX barely registered it. So, of course, elections create uncertainty. Uncertainty filters through the underlying securities, and we see that reflected in the market's expectations of uncertainty. You can decompose that risk further. There's some other events, such as the invasion of the Ukraine back in early 2022, where you saw a similar kind of situation where a premium emerged with the VSTOXX versus the VIX. And that's because even though that invasion was a global event, it impacted Europe more acutely than the US. So going back to looking at that risk again between the VSTOXX 50 and other benchmarks, of course, you have currencies. That's an obvious one, dollar versus euro. And then you have sectors and style factors as well. And I think the key thing there is that these things are not static over time. Right? If you think about the VSTOXX 50, it was traditionally seen as a more financials, bank-heavy index, whereas today the top 2 companies are tech companies, so ASML in Netherlands and S&P in Germany. Still, it's fairly balanced in terms of sector exposures versus the US, which is obviously much more tech-heavy. Tech there is over 30%. And then you look at style factors as well, there's differences, but these differences, I think the key thing is are not static over time and can drive differences in the outcomes of these indices, which create these potentially interesting trading opportunities, which I'm excited to hear about from the other speakers.
Yeah, the difference between the VSTOXX 50 and the S&P 500 performance, I've seen that work its way into the volatility space as well. And I really do think there are, I keep hammering on this, but I really do think there are diversification benefits behind using both markets. Years ago, another volatility index was created, and they created futures on it, and all the traders said, well, we're not going to trade that because it does almost the exact same thing as VIX. VSTOXX does not. Even though they're both volatility indexes, they do have their own unique behavior. There have been some, probably should have led off with this one, but there have been some changes to the structure of VSTOXX and the settlement, et cetera, and definitely would like you to talk about that for a couple of minutes.
Yeah, sure. I'll start off with how the VSTOXX is calculated as a little bit of a refresher and lead into that change we did. So it's a multi-step process, so if you're not familiar with it, bear with me. But first off, what we're doing is calculating the volatility of the VSTOXX 50 on the monthly expiry days. So these are the third Friday dates that are the most liquid. And to do that, we are going to calculate the implied variance of the VSTOXX 50 on those days. And the reason we do that is many years ago, a bunch of clever people figured out that you can replicate the exposure to variance with a very specific portfolio of options, whereas that's not so much the case with volatility. But we can use these findings to effectively calculate what the variance is on that day. Now, to do that, we're going to select a portfolio of options. We're screening the options for available prices, and we're going to create a portfolio that's all out of the money options. We're then going to weight those by the inverse of the strike squared. And I'm not going to go into all the math here. There's plenty of literature out there that does that. But the takeaway you should have is that in that portfolio, out of the money puts are weighted more heavily than out of the money calls. So we now have our implied variance. We're going to take the square root of that to get to the volatility. And now we have our volatility of the VSTOXX 50 on those monthly expiry days. Those are also indices that STOXX calculates. So to get to the VSTOXX index, which is exactly 30 days out, we're going to interpolate between those monthly expiry days, and we're going to get to that exact 30-day window. Now, there's also a settlement that STOXX calculates to feed into that VSTOXX calculation. It's done 30 days out from the monthly expiry date, and that's done by design to promote liquidity around the products referencing the VSTOXX. And previously, that was a half-hour window. And STOXX is always thinking about feedback it receives from the market. And one of the bits of feedback we received was that settlement window could be lengthened to reduce the risk around trading in that window. So we announced a change last year that we were going to extend that settlement window from 30 minutes to 1 hour. That's been implemented since September. And the feedback has been generally pretty positive on that change, where hedgers have more time to hedge their exposure going into that settlement window.
You've been asking around because I knew that change was coming, and I haven't heard any negative feedback at all. And that's rare because traders do like to complain, don't they? Speaking of, we're going to hear shortly how various investors and traders are using VSTOXX options and futures. What do you hear before we jump into the other folks?
Yeah, well, as I said, I'm an index guy, so we have a slightly different view of the world. It's much more longer term, buy and hold, set it and forget it. So we're very much focused on long-term systematic strategies. So I think one shift we've heard over the past year is more interest from our clients on outcome-oriented indices. So this is something that's not new to the investment world at all. In structured products, for instance, these are products where you start with the payoff you desire and back into what that product looks like. Of course, in the US, there's been the success of defined outcome ETFs. But we're hearing more interest in terms of baking some of that into the index wrapper. So building more indices which combine those different payoffs to create a very specific outcome that's achieved. And I think the VSTOXX is an interesting input into that. The VSTOXX can tell you different regimes you're in, which can fuel different methodologies. We also have volatility targeted indices, risk control indices, where we can use the VSTOXX as an input to lever up or down assets to create a very specific volatility level instead of using realized volatility, which we've seen some interest in. But generally, I think we're seeing that interest in embedding more options into indices. And again, that's nothing new, but those have been around for some time. But we're seeing a pickup in interest in that. And we expect that demand to continue.
Okay. Are you gonna create a daily index option selling index?
We've been asked. Yeah, we've been asked. So that would be an interesting one. Yeah.
There's an index for everything. Hey, well, let me make sure there's no questions that have come in over here. You might get dismissed a minute early, and we can jump into Esmail's presentation unless there's anything else you wanted to get across that I was remiss on asking, et cetera. Or I think we're there, but I just want to make sure.
No, thanks. Just to hit the main points. So, the VSTOXX is a measure of uncertainty. It's very much focused on Europe. It's a regional benchmark. There's a robust calculation behind it, and many different usages, even for index investors.
Well, fantastic. Thanks. Thank you. I look forward to. I assume you'll be out in Frankfurt, so I look forward to trying to remember meeting all of you in person out in Frankfurt. It's a weakness that I have. So. With that, we're going to move on to a panel of experts. If somebody can let me know when everybody's on screen with me, that would be awesome. And then I can let you guys go and start doing your self-introductions. I think we're set. Okay, Sophie, would you mind just 30 seconds on yourself? And then I'm going to do Charles, and then I'm going to do Noel. Okay?
Yeah, good afternoon, Russell. My name is Sophie Granchi. I joined Eurex about a year ago. I'm coming from an equity derivative sales background, and at Eurex, I'm the salesperson contact for equity product for the French clients, the Spanish clients, and the French-speaking Swiss clients. In the past, I've been executing and advising a lot of strategies involving VSTOXX. So I'm in charge of promoting the VSTOXX as well for the European region for Eurex.
Charles?
Hello, everyone. Thank you for inviting me. I am Charles Lacarrière. I'm a portfolio manager at Melanion Capital in Paris. I have 24 years of experience trading derivatives in various banks and buy-side companies, and I currently manage the Melanion Volatility Fund here in Melanion.
And last but not least, Noel.
Hi, everyone. I'm Noel Smith. I am the Chief Investment Officer of Convex Asset Management. I started out on the floor of the CBOE in 1996, right before the Asian debacle, and I ran a prop firm after kind of migrating off the floor to upstairs. I was also at the beginning of high frequency trading. I was involved with a firm called Getco, which turned into Knight, which turned into Virtu. And now I run a hedge fund that is really the distillation of what I think are the best practices in the vol space in the US. And our hedge fund is really trying to beat the market using clever vol tactics.
Do you have multiple business cards from Getco, Virtu? I worked at a place once that I had 5 different business cards because we kept changing our name. That's really what I visualized when you say that.
Nobody in the prop space ever asked for a business card, right? So I've got a stack of business cards I've never used.
Yeah, I don't even get them anymore. It's just a waste of paper. All right, with that chit chat, let's get over to Sophie. Just wanted to start out. First, I just want to say that I found when folks make the move from the sell side to the exchanges that they're really valuable to the exchanges. And I'm not just saying that. I work with a lot of exchanges, and people that have been on the sell side and been in the trenches, I think, are a great asset to the exchanges because you have a lot of buy side knowledge and sell side knowledge as well. Before we get into the price action for the VSTOXX futures, how the volume's been looking and how are the efforts around increasing liquidity, which is your role now?
Yeah, well, we have first amended our market making schemes on VSTOXX. We actually amended it twice this year, first in February, and then we adjusted it again in September to target one of the key elements to trade that product, which is the liquidity on screen. And that has been a demand from the clients that they obviously need a full transparency on the prices, and we needed to tackle that issue. And so we did it. Following those changes, market makers are now able to go tighter We have screen as tight as 10 cents on the front month's maturities, and you have as well bigger size on the bid and offers. It's common to see 2K, 3K, on bid offers. Well, before, it was probably more, 500 lots range. So thanks to that, we had a decent increase in volume this year. And a bigger part of the trades are done in the order book as well, which is a big change. And so besides the consistent screen prices, as I said, reassured the market participant in terms of transparency, but as well intraday daily marking. And you mentioned a lot of the QIS strategies before. Those QIS traders, they need those screens to make sure that they have intraday marking to promote their strategy. So that's really a key effort there. So to give you a few figures on the volume growth in VSTOXX, first on the options on volumes on VSTOXX, the volumes are up 44% year on year, and the futures on VSTOXX are up 18%. This is really showing the return of investors in that product, even though, as Ismail was saying before, the first half of the year has been very benign, and showing, already an increase on a volatility product when you have no vol is definitely a good factor. We even had record days with options volume up to 100K on the day, showing as well that you can trade some size. So investors that were worried that you can trade only 1K, 2K clip max and you run out of liquidity, well, now you can easily trade clips of 10K or even 20K on some strategies. The current ADV for futures on VSTOXX is around 60,000. For the options, it's between 30 and 50,000 since June. And I was talking about the order book and more trades on it. Well, we have averaged about 22% of the total trading so far in October in the order book, compared to 7% or even less, at the beginning of the year. So I think, this increase of liquidity is, a fulfilling cycle in a way that it helps, the more liquidity, the more clients are coming, and then it creates even more liquidity and so on.
Liquidity, volume begets volume.
Exactly.
That's what we're all hoping for. We've skirted around the issue, but I do want to, with this panel, dive into the U.S. election and turn to Charles. How is it influencing your current decision making, and what are you expecting once the election? I keep using the word resolved because, unfortunately, I don't know if there's a betting market on a winner being declared within 24 hours of the polls closing, but I would bet against it. So it's going to be an interesting end of the year. Go ahead.
Thank you for the question. So just to talk about the VSTOXX, since we're on the VSTOXX, currently the VSTOXX is at a high level compared to what we've seen earlier in the year, as it has been said. But what is most striking is the ratio of VSTOXX compared to at the money volatility, which is in an 87th percentile, which means that currently the VSTOXX is more driven by skew and convexity than at the money volatility. So the way I see this is that investors are much more worried of a broad sell-off rather than local volatility due to the US election. I believe that what happened in August stays in memories, and the situation in Middle East really generates a strong demand for downside protection. So this being said, if you want to basically protect a portfolio on the US election, well, a very popular trade earlier in the year was to buy the VSTOXX futures maturity of October, which included the event. But this is now over because the next expiry is of VSTOXX future is after the election. So so far today, if you have to play on the US election, it's much more suitable to use weekly option or monthly option. Weekly, you will get the protection, but less Vega exposure, so it kind of makes sense. And it's probably the best way to play it on EuroStoxx so far. However, we all know that there's a big uncertainty on the outcome of this election, even though we can see Trump with a small higher probability. The latest poll I've read this morning still show a lot of uncertainty to me. So market on EuroStoxx currently implies a 2% move on the day of election on the EuroStoxx 50. So this can be, if you want to, well, that's really a play that's really a level you need to keep in mind, because if you expect a very large move like 4%, it still makes sense to buy it. If you think that it could actually be a much smaller move on the EuroStoxx, it's probably a sell. And the way what I would like to point out here is that on the day of election, I'm expecting some dispersion among the equity world, whether it is on between region like US stocks versus European stocks, or even by sectors, because some stocks will definitely benefit from the Trump election, and many will benefit from Harris election. Including those who won't have the tariff that Trump intends to impose on the European stocks. So I think another way specific way to play this election is to focus on single names, and Eurex has many options on most single names. So I think it kind of makes sense for this specific event now that the October future has expired on VSTOXX.
And the single names basically based on what your potential outlook is. I have a graphic that I grabbed off the internet where someone was talking about what sectors you want to own and not own depending on what you think the outcome of the election is going to be. The one that stands out to me is the financials. Apparently, the financials would do better under. This is something I read. Do better under Trump than do better under Kamala Harris. I don't know if that's true or not, but that's a perception that's out there. So sectors are probably the better way to go at this moment. Noel, turning to you, I know you do focus on U.S. volatility. You're the one of the other Americans here with me. Do you give any attention to VSTOXX? How does it play into your analysis of global markets? And expand on any other things that maybe you've looked at VSTOXX in the past for.
So I have looked at VSTOXX in the past. It is something that I look at as much as, say, bond volatility or oil or gold volatility. I look at it in a pantheon of cross-asset volatilities. So if something sticks up, like the French election, like a Brexit, of course I notice, and then I figure out, how is this tradable? Typically, because I'm not on the sell side, I'm on the buy side. I only look at what's actionable and what's tradable. So I'm mostly concerned with, what is it that I'm supposed to do with this information? So if typically you have something that trades in a band and then it expands to a certain level, that's interesting because there's a pairs trade that sets up. Insofar as what's tradable, I totally agree with Charles. There is a dispersion trade here that we have on, and you can kind of game this out. There is really 4 outcomes. Trump wins, Harris wins, neither win, or there is a definitive win. In which case, if there's no win, volatility expands or stays high, probably expands. And if there is a win, no matter what, volatility probably contracts. And then within those wins, you can say, well, is it up ballot, down ballot, and for who? And then how does that work? Typically, I think of something like a Trump win as being good for crypto, oil and gas, regional banking. Then the opposite of that, things that are tariff sensitive with a Trump win are probably bad for tariff companies, industrials. Conversely, with a Harris win, you'd think something more along the lines of regional banks bad. Renewables and healthcare, and then traditional energy would be bad for a Harris win. So you can kind of structure your trades to accommodate either one of those. But until there's some clarity around the election, I think it's very difficult to just rush in right now and slap that trade on.
Okay, I started to throw a hypothetical out there, but I've decided I'm stopping myself. I'm going to stick with the script for a minute here. I do want to get back to Sophie. You're over in Europe, and why should VSTOXX be something that people are considering using around the U.S. election, even though it's supposedly U.S. centric, but probably has a global influence as well.
Well, one of the things is, you have some asset manager here based in Europe with a European portfolio, European underlyings, and they will have to cover this specific risk. And you've seen in many events, like European election and so on. Well, if you had some VIX calls, it was not really useful as a protection. The second point is, the mean reversion. And I remember I mentioned that in one of the podcasts that we did together a few months ago. But I think it's really key in terms of tail hedge, because VSTOXX is obviously less mean reverting than the VIX, and VIX is very well known for reverting extremely quickly, and you will see that a lot of the portfolio managers said it's very difficult to take profit on a strategy that is making some money because of the speed at the speed of the VIX that comes back down. So I would say, because of this less mean reversion effect, VSTOXX effectively, it's having a position on VSTOXX is less difficult to carry. So if you would consider buying some calls for an event, you would have probably, more time to get out of it in case of a non-event, and you would probably be able to carry it better along the way until the event. One of the element that you can look at is, the vol of vol. You have the VVIX versus the VSTOXX. And, just recently, if you would look at VVIX, it's between 100 and then 120, whilst the VSTOXX is in between 80 to 110% in the last 2 months. So just showing that the VSTOXX is less volatile. The third point is obviously VSTOXX is less liquid than VIX. We probably wish at Eurex that it's not the case, but it's a fact. But in a way that means that investors can benefit from a short squeeze on the upside call, for example. Anyone that would provide some calls, upside calls to clients, and would sell those calls very far away would probably don't hedge until VSTOXX rally up to 30 plus level. And in that case, covering those risks is going to be more difficult, which would mean they would have to buy back the calls or just buy back some futures, and that would ultimately push the VSTOXX even higher. So I would say in case of you're expecting a big event, even though it's a US centric event, you can have liquidity effect, less mean reversion effect that could help the VSTOXX to be profitable in case you are long calls. So that's
fantastic. So Charles, you mentioned the market's projecting a 1.9% move. I think that's the number that you said. And someone picked up on that and was asking, could you expand on how you go about calculating that? And do you know what it looks like for US markets right now as well?
The number you can get is basically you get weekly option on EuroSTOXX, so you can see basically a spike on the weekly of the 8th of November. So from this you can assume you have a straight volatility up to the 15th of November, and then you calculate what return makes the extra volatility of the 8th of November. And this morning I haven't double checked for the US. Sorry, I think last I seen was not so far, was about the same number. Maybe Noel can help me on this. I'm not sure.
I was actually going to Noel has an idea as to what's being priced in by the U.S. And really, I'm just thinking about spreading one against the other if there's enough of a difference is where I'm going with that. But Noel, do you have thoughts around that one as well?
Sure. So that's exactly right. It's about the spread, right? Whether the absolute value is difficult to price, but the spread is a little bit more, I guess, tradable. A couple points to notice is that within the NOV expiration cycle, you have FOMC, which is on a Thursday. Now highlight that because it's usually on a Wednesday. So FOMC is on a Thursday, but also within that same expiry, you have GDP and jobs. Well, jobs is in the NOV cycle, right? It's on November 1st. But if you think about the first of the month is the first of NOV and the expiration of NOV is the 15th, it's about as early as it can mathematically get. So there's going to be the idea everyone tries to blast volatility just as the election happens. And if there is a resolution, there are still some important things that are coming within that same expiration cycle if you're trading the NOV reg way. So yeah, that straddle is priced individually higher, but the decay factor actually might be a little bit too steep, which is to say that there's still plenty to talk about, even if there is a contested election and there's all this macro event stuff coming up shortly thereafter, there's still plenty to do within that same cycle.
So I just wanted to stick with you for a second because during the prep call you talked about what you guys are what you would be thinking about doing post-election. I didn't want to put words into your mouth, but you talked about where you are right now and then what your kind of high level plan is with respect to the election. And you did know you were the one that reminded us of the FOMC. I've been meaning to bring that up, that it's the same week. In fact, the straddle that closes on FOMC day is priced just a little bit higher than the straddle that closes the day after the election right now. It's not really surprising. Yeah, not really surprising. So, what are your plans post-election? And I know everybody's doing a little bit of sitting on their hands right now.
So we are also sitting on our hands, which is a really lame answer. But post-election, the reason that I'm most hesitant about my answer, which I'll give anyway, is that everybody has the same answer, which is a really dangerous position to be in. If the entire herd goes that way when the lion's coming at you, you got to look for the other lion, and it's right in front of you that you didn't see. We basically plan on selling vol, and there's several different ways this can resolve itself. How do you get in front of this, and what do you do in the here and now? I think a dispersion trade sets up really well because there is possible outcomes that we've already discussed. But what that really means is that, a set of single names can move in one direction or that same set of names can move in a different direction. And either way, you can capitalize on that. In terms of hedging this, I can tell you what we've done specifically. We've leaned into the within VIX, not VSTOXX, the NOV 30-40 call spread. And I've had this on now for months, and it's been an interesting trade because I was able to buy it, I want to say July for 46 cents, 50 cents average price, give or take. And then it went up to a few dollars in August 5th. We basically cleared out of it, sold it a little bit on August 2nd, and then on August 5th as well. Then we were able to buy it back for 40 some odd cents, and it's trading around 27 cents today. And I think that trade is a loser in the sense that I don't expect it to play. But if you're looking to hedge some kind of a wild unknown event, which is by definition exactly what we need to get volatility, because if it's known, then it's already priced in. I think that is a relatively cheap way to play for craziness.
Charles, kind of the same question to you, and then I'm going to finish up with Sophie on some more stats around the markets.
Yeah, well, Europe is kind of stuck between its own problems, the US election, and what's happening in China, where recent news are a bit more encouraging with a large stimulus. But from profit warning we've had in Europe to US election, which can have actually, I agree with everything Noel just said. Except one part, which is that I think Trump could create volatility in Europe, mostly with his tariff that he can impose on many stocks that can have a very strong impact on many sectors and single names. So Trump could generate volatility, and we can still see some volatility from European companies generating their business in China. So I'm not 100% sure volatility will be completely dead after the US election.
There's always things going on in the world, for sure.
And we're bang in the middle of it.
So,
Sophie, I agree with Charles. Oh. Sorry, I agree with Charles that if these tariffs come in, I don't know what % of those tariffs are bluster and threat versus what would actually be actionable. But a lot of that has already been kind of gamed out by the fundamental community. But I agree with Charles totally that, you know, the idea that a Trump election smashes vol is not a known.
Yeah, there are a lot of other things in the world after the election that we still have to deal with. Sophie, I'm going to let you take us home on this one. Could you comment a bit on recent VSTOXX flows? And you know, with volume going up, there must be some new participants in the markets. If you could talk about that as well.
Yeah, well, you know, we haven't seen a clear trend into the US election on VSTOXX flow. There's been some buyers of upside, some buyers of puts. If you look at the open interest in November, 40% puts, 60% calls. I would say surprisingly, the largest open interest is actually in December and not in November, where you have a large open interest on the DEX 30 call, and you've got as well a large open interest on the 17 and 15 puts in DEX due to this large 17-15 put ratio that was traded a couple of weeks ago. So, you know, if I looked at the trades that happened last week, we had buyers of November 15 put, DEX 16 put, buyers of November 30 calls, DEX 34 calls. So really a good mix of even that could, you know, in a way say that, you know, vol is probably not going to be a sell-off straight away. And people are still hoping that, you know, for December, there's still going to be a bit of volatility. In terms of new participants, well, we've been lucky enough to see, you know, more new players. Those are, you know, first hedge funds who wanted to play a Europe specific event, for example, like the European election. That definitely was one of the key catalysts for people to come back to the VSTOXX. Then, you know, we have some US hedge funds. We've done a lot of marketing effort to promote the product over there. Obviously, the US hedge fund community is very aware of the VIX product, and that's very easy for them to switch and to trade the VSTOXX, especially as it's CFTC approved. And then we had as well European vol players who used to trade VSTOXX, but, you know, we're not really so happy about the liquidity before, and we have seen, you know, the changes we have done in terms of, you know, screen, but as well, you know, the methodology, and we mentioned the change in the settlement price calculation. That is definitely making some participant coming back. So, and the last but not least is the QIS desk. They are starting to get active in VSTOXX futures. That will bring more liquidity. We know that, you know, the demand for QIS products is almost unlimited or limited to the risk that the banks want to take. So this is definitely one of the areas that can bring more liquidity into all our products, actually, whether it's VSTOXX or dailies or, you know, anything else.
All right, well, fantastic. We're hitting our marks. Everybody's giving out really great information. I think we're all kind of looking forward to seeing how the election shakes out. And I know people in the US are just kind of hoping to get it behind us and move on in life. With that, we're going to turn to our last session. I'm going to be speaking with Matthew Corin from Eurex. Matthew does some great work every week that makes my life a lot easier, and I want him to talk about that a bit. Matthew, can you introduce yourself and let us know what your role is, et cetera, at Eurex, and then we'll jump in on what you're doing to promote VSTOXX, which I think you're doing some great work.
Sure, absolutely, and good seeing you, Russell. I'm
Yeah.
effectively Sophie's counterpart in the U.S. So I cover VSTOXX globally and help Sophie push VSTOXX to the global audience. But I also then cover the U.S. Vol community as well as the sell side. As for your question around or your point around what we're doing in the United States, I think what you were alluding to is kind of the weekly color that we've started to put out. I'll take a step back for those on the call that don't know what we're talking about. One of the things that we did at the start of the year, the exchange as a whole, was kind of look at the U.S. volatility space, the European volatility space, and kind of see what's missing, what's different. And I think a big part of or the big difference between those two markets is the amount of publicity you see around the U.S. markets, right? If you go on Twitter right now, you're going to see 1,000 people talking about VIX, their thoughts on the U.S. election, S&P vol. CNN's literally on behind me. They're telling me where VIX is, and that's not even a financial news source. The retail community in Europe is much smaller than it is in the U.S. So I think to a certain extent that it's expected that VSTOXX isn't as widely pushed. But we wanted to kind of level the playing field a little bit from an exchange standpoint. So we started putting out weekly color commentary. We call it the weekly VSTOXX rundown. We started by sending this directly to institutional traders. I think over 5,000 people get it at this point. It's since expanded to now a Substack, what you can subscribe to if you're a retail trader. Europeanvolatility.substack.com is if you want to subscribe to it. We'll note there's not much on that Substack just yet, given we just recently started adding to it. But we do a little rundown on block trades on the option side. We do a rundown on term structure, what part of the curve is trading. A lot of the volume metrics that Sophie just pointed out, we provide every week, as well as put call ratios and things like that. So, the fact of the matter is from the US, we don't expect anybody to have VSTOXX at the front end of their or on the landing page of their Bloomberg anytime soon. So we can at least, provide them kind of weekly commentary on what's trading in the market.
I have it on my Bloomberg.
Good.
But I'm a little bit odd. So, since you're in the U.S., what are U.S. perspectives on European volatility? And just what kind of feedback do you get from U.S. investors regarding VSTOXX, maybe trading it, looking at it, et cetera?
Yeah, I think you have to kind of bifurcate the future side from the option side, because I think there's kind of two different use cases. I shouldn't say use cases, but two different kind of ecosystems there. If you look at the future side, and let me actually take a step back, as Sophie mentioned, VSTOXX futures and options are CFTC approved. They're options on futures. Retail can trade them from the United States. They're one of the few options products that Eurex has that retail can trade. Interactive brokers, believe it or not, is one of the few ways that you can trade Eurex options from the United States. But the options and futures ecosystem is definitely split. A fun stat I'll give you is roughly 10% of all VSTOXX futures are traded after the European cash close. So in theory, that is volumes that are not related to European volatility in any way. It could be, somebody, making a play on a U.S. macro event. But what we see is a lot of systematic folks, a lot of stat arb style guys that don't trade or don't care if they're trading VSTOXX futures or lean hogs. At the end of the day, their model says buy one, sell the other. So we definitely see a lot of stat arb systematic type folks coming out of the U.S. A lot of relative value guys trading VIX versus VSTOXX. I know, that was talked about previously. That trade was obviously very well publicized in June when we had the snap elections in France. And to a certain extent, you still kind of see it right now around the U.S. election. I think it's kind of interesting to look back. If you looked at the VIX VSTOXX spread, looking at the October future at previous elections, if you looked at the Trump Biden race in 2020, VIX traded at roughly a 4-point premium at settlement, or near settlement, I should say, not at settlement. If you look the election prior, Trump Clinton, VSTOXX traded at a premium. This October expiry, it was kind of a nothing. VIX was at a slight, 1.5 point premium over VSTOXX. So, that's obviously a heavily traded play in the United States. There's obviously term structure guys that trade one contract, sell the other. Again, some retail, some hedgers, though the hedging is not nearly as big as some of these other strategies. On the option side, it is much more institutional. It is much more pure vol focused. Guys trading VIX versus VSTOXX again, EuroStoxx versus S&P, and then more of this is driven out of Europe. But I mean, VSTOXX was created, as Hamish noted, as a way to hedge EuroStoxx 50 volatility. So at the end of the day, it is heavily used as a way to hedge out European volatility exposure, again, around things like the election, though we don't see that as much in the United States, as you don't see those chunky European volatility books in the US.
So we talked a bit about, and I hate to put you on the spot like this, but we talked a bit about what you put out and the trades that you're looking at each week. Are there any particular strategies that come up often, or ones that you like better than others? Without, you're not giving a recommendation here. You're just saying that seems to make a lot of sense there. I'm not trying to get you in trouble. I'm just
No problem.
So,
Yeah, I would say Bloomberg Intelligence actually put out a pretty interesting piece, and it was more VIX related than VSTOXX. But what they noted is the last couple of weeks, generally into the election, vol goes quiet. For the most part, people kind of have their hedges on, they have their positioning on, and then the last couple days into the election, there's a couple guys that say, "Oh crap," and have to hedge something. So last couple of weeks have been pretty quiet. Sophie noted, one of the big trades that we have seen, and this was a trade that was very publicly promoted by JP Morgan and their strategy team, was that 1x2 put spread, primarily December focused. I think it was the 15-17 strike. Most of that activity that we're seeing is in December. I think most of the volatility community does see a contraction in vol post-election. Selling vol does seem like the logical play. Do we go back to VSTOXX 12 anytime soon? I'm not sure, but I don't know if VSTOXX stays at 18 in December. I think it's also interesting to note that December expiry gets you 30-day volatility after December expiry, right? So that gets you pretty much to the inauguration. I don't know if there's a lot of camps out there that are saying the inauguration gets moved, or there's a contested election to inauguration day. So it seems like, selling vol in that December area is kind of the big play right now. You see some of it in November. But as Sophie pointed out as well, there are definitely players that are hedging, a vol blowout as well in November and December. There's definitely some guys trading that 20 handle, that 30 handle, again, both November and December. I think, one of the things we've kind of forgot about in the last week is there is a conflict between Iran and Israel still brewing, and that can explode at a moment's notice. So, that 1x2, 15-17 put spread does look attractive to many, but that could be a losing trade pretty quickly if what's going on in the Middle East escalates.
And it's not just the Middle East. The South China Sea, everybody keeps running boats into each other, and Ukraine, Russia continues to drag on, and looks like it might get escalated because Russia's getting soldiers from other countries now, and we keep giving them better guns to work with. So there are a lot of reasons to maybe be worried about a volatility event overnight and waking up in the U.S. and seeing VIX and VSTOXX up in the 40s once again because something escalated. Somebody shot the Archduke or whatever. That's how World War I started. So finally, with you, what's Eurex have in store for the volatility space for the next year or so? Anything new? Any enhancements, et cetera?
Sure, and I think Sophie kind of did a great job of pointing out what Eurex did in 2024, and I'll kind of take a step back. I think some of the other exchanges in the United States have been very public with some launches this year, options on futures on VIX, variance futures, things like that. Fact of the matter is Eurex has had those things for many years. We've had options on VSTOXX futures now for, I believe, 7 years, variance futures for a couple years. Those new innovative products that we're seeing in the United States, Europe has had for a while. So, what we've been focusing on at Eurex, again, specifically in VSTOXX, is how do we improve liquidity in kind of our existing products? I think, as an American, I think everybody kind of looks at the US markets and says, well, those are heavily screen traded. If you look at the European markets, that's a heavily block traded market. And I think the fact of the matter is that's a misnomer, right? If you look at the index volatility space in the United States, particularly what's traded in the pits, and you compare that to block volumes that we see in Europe, they're not all that different. Single space world, I think, is a little bit different, but the index space is not so different. What is different between the US markets and European markets is really the depth of the order book and the ability to be able to interact with the order book in a much more sophisticated and a complex way. So that's something that we've been focusing on at Eurex is, well, how do we improve the VSTOXX order books so that if you want to trade 20,000 VSTOXX options in a clip, you have the ability to do that. So, Sophie pointed out some of the new liquidity schemes that we put into place. Really, that new scheme that we put in place in February is what supported the rest of the year. We had two big vol shocks in the year. One was the Iran-Israel conflict, the first wave. And obviously, we had the French election. And if it wasn't for that new LP scheme, we don't believe we would have seen the volumes that we saw go through in our options. Obviously, we put a new LP scheme into place in September, both from a options and future standpoint. The exchange is agnostic as to whether you trade blocks or you trade in the order book. But one thing that we can say is historically, from an option standpoint, roughly 7 to 8% of VSTOXX options have traded in the order book. That number is closer to 22% in October. So if you are a systematic and you are a order book driven guy, it does seem like more volumes are going through the order book, which is reassuring. The other thing that we did in September, liquidity-wise, was we put through a new LP scheme for VSTOXX futures. So VSTOXX futures have always been relatively tight, generally a tick wide for the first, second, maybe even third month expiry. But the problem with volatility futures, whether it be VSTOXX or VIX futures, is nobody wants to put 5,000 on the bid or the offer because if you do get a news headline, the market's going to move in your face pretty quickly. So, we put a new LP scheme in place to really deepen the market. The market is now effectively twice as deep as it was, and we're only 50 some days into the new scheme. And ultimately, that should support more hedging on the option side. And as Sophie pointed out, we expect, if we deepen the order books from a future standpoint, that will support the options. More options trading will result in more futures trading. And this is kind of the initial catalyst to really build out, the VSTOXX ecosystem. Obviously, Sophie pointed out, and I think Hamish pointed out the new settlement change that went into effect in September. That has introduced a number of new vol shops that previously kind of were on the sideline. They have already indicated that they started trading VSTOXX options, and we've only had 2 expiries now with the new settlement. So it's very encouraging. So this is all things that we've done so far in 2024. What's in store for 2025? We can definitely look at things like potentially weekly expiring options. We can look at dailies, like some of our U.S. peers are indicating that they could look at. We'll call those mid-curve if we want to, keep the nomenclature the same. I think variance is going to be a big push. And then, we're also looking at, are there other volatility indices that we should potentially start looking at? I think, obviously VSTOXX 50 is Eurex's bread and butter, and it's the premier index in Europe. But I think it would be naive to think that the VSTOXX 50 is going to be the premier index 50 years from now. So we've seen some tremendous flows this year in STOXX 600. Exploring possibilities. Hey, should we be listing a volatility index on, STOXX 600? Should we re-explore, some sort of derivative on VDAX, which is the VIX of DAX, things of that nature. So, I'll end with 2024 was a year about really rebuilding the VSTOXX ecosystem. I think 2025 you'll see new kind of products come to market. I guess I'll end with, if there's any PMs, institutional traders on this call that have any thoughts on where the exchange should go in 2025, new products, things that we should be looking at to improve the ecosystem next year. We are all ears. Obviously, don't shy away from reaching out to myself, Sophie, any other Eurex colleagues that were on this call.
Yeah, a lot of people don't realize that a lot of the changes that get made or new products, et cetera, start out with people reaching out to people like yourself.
Exactly.
So yeah, I think some people are kind of amazed when they have an idea and then all of a sudden 6 months later they're hearing about it at the exchange. So it does happen. All right. Well, I greatly appreciate that. This 2+ hours has flown by, to say the least. And I've got 5 pages of notes, and I'm supposed to be moderating, and I was able to take that much in notes. So just a quick wrap up. This is a precursor to the derivatives forum that will be in Frankfurt at the end of February. I think just about everybody that was participating, or a good number of people that participated with us today, will be there. If you see me there, please say hi. I'm very much looking forward to it. It's one of the best conferences I've ever been to, and I'm happy that I get to go again this year. So with that, again, thanks for joining us. Hopefully we'll see you in Frankfurt in February of next year.